We have a lot of people from inland on the call today, and great people that can help you with your financing goals. With that, we have an awesome speaker, well respected on the national level. Robert Dietz is the chief economist for NAHB, where his responsibilities include forecasts of housing and economic trends, survey research, and home building industry and policy analysis. Prior to joining NAHB in 2005, Robert worked as an economist for the Congressional Joint Committee on Taxation. He's a native of Dayton, Ohio, and earned a PhD in economics from The Ohio State University in 2003. So with that, Robert, they're all yours.
Great. Yeah, thank you, Frank and Jim and Tracy for setting this up. I don't know if we can emphasize the and the Ohio State University after the game Monday. It was a little embarrassing. I guess the technical term was a curb stomping, but it's good to join you all. I was telling everyone as we were getting online that I'm a Midwesterner, my wife's a Midwesterner, so it's always good to do forecast talks when we're talking to folks in the Midwest. And I think one of the things, and you'll see it in the slides, is that we are seeing some shift away from housing demand, concentrating in some of the larger markets like New York and San Francisco, particularly on the rental side, and moving to more affordable markets, big and small, through places like the Southeast, and we've seen a lot of that, but also I think in the Midwest. And one of the surprises in 2020 was not just the strength of housing demand as the market began to pivot, but the fact that some of these markets in the Midwest really did begin to pick up some strength. So let me go ahead and I'm going to share with you a slide deck, and I hope you can all see it. We'll start with the headline findings. It's impossible to do forecasting these days without doing, kind of what we think the impacts of the virus and vaccines are. And that's a tricky business. I'm trained as an economist, which means studying finance, but we're all data analysts, and we have to look at the life science data as well, the virus data. So we think in our forecast, and this is kind of part of forecast and part of an assumption, that the virus crisis will continue through the end of February. And what we mean by that is that's the period of time in which we will continue to risk lockdowns and shutdowns undertaken by state and local officials, whether they're effective or whether it's just simply they feel like they have to. I will say from a personal point of view, it's been a little frustrating to kind of follow the hospitalization data in 2020 and going into this year. It always seems like the hospitals are just a few weeks away from being overrun or overtaken. That has not happened, but nonetheless, we have to take very real the ability of state and local leaders to shut down economies. So the good news, I was just looking at the data before I signed on here. We've got about 10 million Americans now that have received their first shot of one of the two vaccines, the Johnson & Johnson, the third vaccine, which is a single shot vaccine, has just been approved. And so the manufacturing capacity for vaccines seems to be there. The data seems to indicate that the shots are fairly effective once you go through the full regime, and you have to give them about 10 days to really kind of take effect. But we're probably looking at, by the end of April, maybe into May, half of Americans having received at least one of the shots. That will really kind of be an important pivot point, April, whereby herd immunity will essentially have been jump-started by the vaccine itself. And we think we'll probably reach about 75% by the time we get to Halloween. And that mostly just leaves children, by the way. And there's a discussion right now whether or not to vaccinate children at all, whether kind of, just getting the virus itself and getting that into their system will ultimately get us beyond this. All right, so what does that mean then for growth? And the slides I'm going to walk you through in terms of GDP growth. Expect some downside weakness for the first part of this year, but accelerating growth in the second half of 2021. And again, that's connected strongly to the vaccine itself and the ability to open up the service sector, the hospitality sector, restaurants, bars, all those parts of the economy that are essentially right now operating at 40 or 50% of their actual capacity. Now, there's good news, bad news here. As growth accelerates, obviously that's good for housing demand, but more growth means more demand for capital from the rest of the economy, and that means higher interest rates. So as growth accelerates, as the job numbers get better in the second half of the year, you're going to see more and more pressure on interest rates. And in fact, we actually had, starting over the last 2 or 3 weeks, some uptick in the 10-year Treasury already. So we've likely hit the point at which the 30-year fixed rate mortgage has bottomed out, and it's only going to go up from here. And by the way, the reason for that uptick recently in the 10-year Treasury, it was the Georgia Senate elections. The fact that the Democrats won both of them, and now we're looking at a 50-50 Senate with the incoming vice president as the tiebreaker, means that bond markets are basically saying you're going to get more spending because the Democrats are in charge, and that represents an inflation risk. So when inflation risks go up or expectations go up, those nominal interest rates increase. So I'll walk you through our forecast on that. What does that mean? Well, we think 2021 is going to be a fairly positive year for housing, but it's not going to have the growth rates that we saw in 2020. There was lots of upside surprise in 2020, historically low interest rates, changing geography of housing demand. It probably accelerated some housing activity from 2021 into 2020. So we expect growth this year, but it's going to be at lower growth rates. And that's particularly true in the single family sales market, because what we saw was a growing number of builders selling homes that hadn't even started construction yet in the second half of 2020. So there's going to be some slowing in the data. Now, I'm not saying that to be overly negative, but also just kind of alert you that one of the challenges we're going to face in 2021 is media. In other words, when some of these softer reports come in, even though they're positive, even though they're along the trend line that we've been on since the Great Recession, there are going to be some in the media who are going to try to spin it as bad news. So just be aware of that yes, some of the things are going to be a little bit slower, but generally speaking, a fairly positive market. And that's going to be true for single family construction. It's going to be true for remodeling. There is going to be weakness in multifamily. Multifamily construction is, without a doubt, going to be weaker in 2021 before it begins to stabilize going into 2022 as that service sector comes back online and the demand for rental units, particularly in high density areas like New York, like San Francisco, to a lesser extent, like cities like Chicago, comes back into the city. And so that's going to take a little bit longer, and we'll see the multifamily market recover last. From an advocacy point of view, the big challenge is going to be housing affordability. And I know in the housing industry, we can say that any given year, but given the combination of the really fast run up in home prices that we had last year, about an 8% average increase in home price growth, combined with interest rates trending higher and higher development costs, particularly on the material side, all these factors suggest tightening housing affordability conditions through the year. So the demographics are good. The homebuyer preferences are all moving in our direction. And really from just a pure advocacy perspective, and this is why it's so important, to be a member of the local association, participate at the state level. I saw Bill Ward sign on and get involved at the national level, is because housing affordability really is going to have an impact this year as it prices out some buyers due to the run up in prices that we saw last year. All right, so let's dig into the details. I welcome your questions at the end. In terms of the GDP outlook, you can see the second and third quarter on this graph clearly. The second quarter was the worst quarter we'd had for the U.S. economy in terms of growth since the end of World War II. It's just what happens when you hit the brakes on the economy. And it's a reminder, I know you all know it, it's a reminder that government can shut markets down really fast with bad policy. So I'm not going to get into the debate over whether or not lockdowns, particularly what we went through in March and April, were effective or not. I think those studies are coming. And as things cool down a little bit, we'll look at that, because let's be honest, this is not going to be the last pandemic. We had SARS 17 years ago. There's another one out there. Maybe it's a decade or two from now, but we need to evaluate whether those tools that policymakers enacted were effective. But you can then see the potential in the economy. The third quarter growth rate, 30%. So the economy rebounded fairly quickly. And so among economists, there was this debate, what letter shape was the recovery? Was it V shape? Was it K shape? U shape? If you look at the second and third quarter data, that's about as V-shaped as you can get. I understand what some people mean by K-shaped recovery. They mean there's kind of a two-tier group. If you own stocks and bonds and investments, 2020 was probably a pretty good year. If you were at the lower end in the service economy, low wage work, 2020 was probably a pretty tough year. But it does seem like most Americans right now are improving in terms of their condition. So I would argue on net, that would suggest a V-shaped recovery. And then you can see in our outlook, the blue bars, they're a little bit smaller at the start of 2021, and then accelerating into the second half of the year, going into 2022. So we're looking at about a 3.6% growth rate. And I think 2022 will be stronger still. The wild card here, overregulation, because the temptation is going to be with a Democratic House, a Democratic Senate, and a Democrat in the White House to push out a lot of regulations without a lot of stopping them. And that could interfere with the rebound of the economy. And so I think Joe Biden, among the Democratic candidates, is probably going to be the most cautious in terms of some of those regulations, but that is going to be a key feature that could slow the economic rebound going down. Now, one analogy that we've used for some of the changes that occurred in 2020 is to look at restaurant sales data and grocery store sales data. And you can really see the substitution effect that occurred in a lot of different sectors with this data. The red line is restaurant sales, goes into 2020 and just drops by 50%. But with that drop, you have grocery store sales surge, the blue line going up. And then you can see the kind of normalization. And this is a big theme that we're hitting, these temporary effects, the big divides, and then persistent effects. And the persistent effect that came out of the Great Disruption or the virus crisis is the fact that grocery store sales are now higher than they were, and restaurant sales seem to be persistently lower, at least until we get a mass deployed vaccine. So if we take a step back and we look at the overall economy, and this is the reason the housing market really benefited in 2020, you can see the service sector, which is the red line. Both sectors here, services and goods, both decline. You can see the service sector is lower, like restaurants, and the goods economy is actually larger than it was before. And this, by the way, answers part of the question I know a lot of people have had is what's going on with the lumber market and the building material market. There's just a lot more demand for physical goods in the US economy right now, combined with supply chain disruptions. And so you see a lot of material costs either higher or there's delays in arrivals. And that's because that blue line is larger than it was. Those kinds of effects that occur that quickly are going to have lingering disruption effects. And that's what the economy is going through right now. The other thing, and I'll admit, most economists tend to be short-run pessimists and long-run optimists. We like markets, we like growth, we like competitive elections. And so I will admit that some of the down-talking of the US economy, and frankly, the US performance during the virus has kind of rubbed me the wrong way. I'm just putting this up here as kind of a footnote to remind people, hey, the US economy has actually done pretty well in 2020 compared to many of our peers who the media seem to suggest are doing better than we are. So if you look at this is the 2020 GDP growth rates. For the US, we were down 3.6% on the size of our economy in 2020. The China number, they're up 2. Now that's a lot smaller than what they were growing before, but I'll tell you straight up, I don't believe Chinese numbers anyway. So let's just put that as an asterisk and we'll move on. South Korea went through SARS. They were better prepared for a pandemic. Their economy is only down 1%, although they are facing rising cases right now. And then if you look at a country like Australia, an island easily protected from the pandemic, the same economic decline that you see in the US. That's remarkable. It means the US has really persevered on the economic front. And then look at some of our near peers, Japan, Germany, Canada, all down 5 to 6%. And unfortunately, the United Kingdom down 11% on the size of their economy in 2020. So, the media right now is telling a story of sort of the US has performed the worst in terms of the virus. That's not true. And it's not true, particularly on the economic side. So just as a footnote, I think it's important to have out there. All right, so we talked about growth. What about the labor market? The unemployment rate right now is a little bit below 7%. You see that red line? It probably peaked at about 16 or 17% in 2020. So it came down pretty quickly after rising fairly quickly. The challenge right now is that the improvement in the unemployment rate is going to be slow going in 2021. And in fact, we saw 2 data points just in the last few days of this. We had a job loss, net job loss in December. That was the first job loss since April. And then this morning's initial jobless claims number, which is a little misleading because some of it was holiday delays and there was also some policy impacts in there, but jobless claims did increase. So that red line is going to continue to fall. We think it's probably going to get it to about 5% by early 2022, but we're not going to see the dramatic gains in the unemployment rate that we saw earlier on. From a policy perspective, the real challenge is the fact that we've got a growing number of people who have been unemployed for more than 6 months. And when you're unemployed for more than 6 months, your big life cycle decisions tend to change. Things like buying a home, sending your kids to college, buying a car. So there's more than 3 million people now who have been out of work for 6 months. And again, a lot of them are concentrated in the service economy. That's a policy challenge. We need to address that over the next year or so. In terms of local data on the labor market, in terms of the US, it's down 6% from its peak level of employment. So we were down 12% at its peak. The Chicago area, fairly similar pattern actually to what we see for the US in terms of the impact of the pandemic, down about 7%, so real close to the national average, maybe just a little bit less. You see this, by the way, throughout the Midwest, just lagging just a little bit, but pretty close to trends. And if you're interested, by the way, the local markets where the labor market is just a disaster, is not a surprise. It's places like Las Vegas, Honolulu, even Orlando, I would put in that basket. The peak unemployment rate in Las Vegas was above 30% in the spring. So they've got a lot of labor market healing to do. And so being near the national norms is actually a good place to be. The other challenge with the labor market is the big drop in the labor force participation rate. So it's one thing to say the unemployment rate's getting better, but if people aren't looking for work, you have a dual challenge. One, they're not employed, but two, you could also then have businesses say, hey, I'm trying to rehire, I can't find the workers. And of course, this has been a challenge for construction for years. Well, the reason for that sort of seemingly disconnect between high unemployment and businesses not able to fill positions is this drop in the participation rate. And it fell from 63% to 61%. And unfortunately, a lot of that drop is connected to women in the labor force. Why is this? The schools are closed. And, for traditional reasons, I'm not saying they're good or bad, but you've got more women dropping out of the labor force to watch kids who are doing online schooling. This is why economists of left and the right universally agree we need to reopen the schools as quickly as possible because they have a follow-on impact of improving the labor force participation rate of women and getting more people out looking for work. So this is another policy challenge for the coming year. So we talked about this at the beginning. We think interest rates are headed up. The blue line here is the 10-year Treasury. It's already headed higher. It's been right above 1.1% over the last few days. And then the red line, this 30-year fixed rate mortgage, I think it's bottomed out now, and we're going to start to see incremental gains going forward. And, these are straight lines in our forecast. We know these things will happen with sudden jumps. So kind of think of those lines as the averages. The good news is I think the 30-year fixed rate mortgage is going to remain below 4% for at least the next 2 years. The bad news is rates are headed higher. So as rates go up, you're going to have a certain number of potential buyers pull out of the market. Historically speaking, these are still historically low interest rates. And we have an ally in the Federal Reserve in this fight. We take the NAHB senior officer team to meet with the Fed at least once a year. We met with them in April during the peak level of the crisis, and they fully understand that the primary mechanism by which the Federal Reserve can boost the economy is the housing market. So I don't think they're going to do anything that would cause housing demand to greatly retreat. Our challenge is just going to be that as growth expectations go up, a 10-year Treasury is going to go up, and that pushes the 30-year fixed rate mortgage up. So, yes, rates are going to go up. I don't think they're going to be a big break in demand, but they are going to carve some people out of the market who could otherwise buy a home. And the demographics for the U.S. are fairly positive. Every economist has got some version of this slide. It's just looking at the population profile of the United States. The horizontal axis is our age, and the vertical axis is a count of people. So that blue line going through the slide is basically how many people are there at each age. And I divided it up into generational groups. So I got my Gen X group. We're kind of a smaller generation right there in the middle. And then right to the left of the Gen X group are the millennials. You can see they're the largest generational group, the easily largest generational group in American history. And the leading edge of them is age 40. And as they move into their 40s, the demand for single family homes is going to go up and up and up. And we already have an inventory shortage in most markets, and that is going to increase. If you're a gloom and doom type person, you can look at Gen Z, and then behind them, since we're out of English letters, we're calling this group at the bottom where my kids are Gen Alpha. They're smaller generational groups, and that will have impact on rental markets and apartment markets about 10 years from now, when housing demand begins to retreat, unless we have a big uptick in immigration. But for the next 10 years, the runway for housing demand is very strong, and it's going to be led by the fact that the Gen Xers are going to be in their peak earnings years, and maybe you're moving to their dream house as they enter into their 50s, and the fact that the millennials are just a huge group who are going to be looking for housing. In terms of regional population growth, the leaders have been the South and the West. We have to be careful about saying the West because the Pacific coast is weakening while the mountain states are growing a lot. But I think 2020 is going to reverse some of this. So you can see the Northeast actually is negative 0.3%. Unfortunately, that's likely to continue. But the Midwest has been flat. And I think there's some trends suggesting, in certain cities where it's starting, and this is places like Columbus, Indianapolis, Kansas City, St. Louis, that there is some population growth occurring. And businesses are giving the Midwest another look with the rise in telecommuting and the ability to maybe say, why are we based in Washington, D.C.? Why are we based in New York, in Boston, and San Francisco, when we have these cities in the Midwest that have universities nearby and a relatively lower nominal cost of living? And so I think if communities take advantage of that, they can lure businesses and households into those markets. And so I think there's a window of opportunity here for the Midwest over the next year or two. It's going to be small, but there's a real opportunity to get some population gains. And then if we look at the hyper-local data, I'm not telling you anything you don't know here, but Illinois posting population declines, and the Chicago area posting declines since 2015. We don't have the 2020 numbers yet, but obviously these are things that need to be reversed in order to make housing demand more robust locally. Property taxes, regulatory rules, all those advocacy issues that are so important to work on are clearly part of that equation. And again, if you marry the opportunity here with the fight that's been ongoing on some of those issues for a long time, I think membership over the next year or two is going to be absolutely critical to engage and maybe take advantage of those opportunities to lure businesses in from the West Coast and the East Coast where costs are just out of control. And we're talking about the geography of housing demand. Here's the county level home ownership rates. Blue is good, red is bad. I like to joke I don't get often invited to go speak in California. I mean, you can see California is the state to not imitate, right? They have, through regulations, taxes, making it hard for Gen X and millennials to become homeowners. They've just driven their homeownership rates down, and they're driving their population out to places like Texas, Utah, and Idaho. The homeownership rate for the Chicago metro area is higher than I think most people nationwide would expect it to be. 65% is really close to the national average. So that shows you that balance between the inherent advantages the Midwest has, but then being tampered down, of course, by some of the property tax burdens and some of the governance issues that would hold things back. But this map really kind of illustrates the fact that over the last 10 years, places like Portland and Seattle and much of California has driven away younger households and driven those homeownership rates down. All right, supply side. Lumber, and I'm going to talk a lot about lumber here on this slide, but we understand it's OSB, it's other building materials. The roller coaster ride continues. Lumber prices increased more than 170% from mid-April to September. Then they came down as it looked like production was going to increase, and COVID began to spread really in some of these rural areas where you have sawmills. Production came down. Canadian imports declined 5% in 2020. And the result is that lumber prices are headed back up again. They're going to test some of those highs that we saw in September, unfortunately. This is the number one advocacy issue at NHB right now, is to try to get some certainty in the lumber market. I met with Jerry Howard for an hour this morning on this, getting all the groups at NHB, legal, regulatory, legislative, my economics team engaged on this. I think we might have a commerce secretary, the former governor of Rhode Island, coming in, who might be sympathetic to some of our arguments about trade restrictions and increasing domestic lumber production. So that could be one cabinet secretary who can actually be an ally in some of these regulatory issues. We're also talking about maybe having some kind of summit of all the stakeholders in the wood industry and basically say, you know, we don't want to make enemies of the sawmills, but what do we need to advocate on behalf of the industry to produce more lumber in the US? What are the issues that are the top issues, instead of a kind of a finger pointing exercise that we've engaged in the last few years? So we understand this is a huge issue. It's adding tens of thousands of dollars to the price of a newly built home, and we are working on it. And again, I understand in our surveys it shows up very clearly. Other building materials are more expensive, taking longer to occur. And so new home prices are headed up this year because of those supply side factors. Labor shortage continues to be an issue in much of the country. The red line here is an intensity measure of the skilled labor shortage. It's less than it was, say, a year ago, but that's because non-residential construction right now has only recovered about 60% of the job losses that they had this spring. Residential construction, by the way, is as large as it has been in terms of the labor force since the Great Recession itself. We're one of the few sectors that has actually added jobs during this particular crisis. And that's a confirmation that, yes, indeed, we suffered from a labor shortage. So we're taking advantage of some of those other job losses and bringing people into the sector. But of course, we have to train them as well. And so I think one of the, again, another advocacy issue that NHB, state associations are going to be working on over the next couple of years is working with community colleges and trade schools to train people alongside, of course, the HBI, the Home Builders Institute. And I think labor regulatory issues are going to be a big deal. I'll give you an example of one. In 2015, there was something called the Joint Employer Rule, which would treat the home builder as the employer of record for even tasks that were subcontracted for things like kitchen cabinets, countertops, framing, tasks where 80% of the jobs are done by subcontractors. Those kinds of rules, the Joint Employer Rule, independent contractor misclassification, with a Democrat running the Department of Labor, they're going to be under the rulemaking process. So I don't think it's going to have an impact in, say, 2021, but those fights are going to need to be had because they could affect things in 2022. And of course, we understand all these regulatory costs add up. This is some analysis we did in 2016. You've probably seen it before. About a quarter of a typical newly built home's purchase price is made of regulatory burdens. We do the study every 5 years. So later this year, there's going to be an update of this study. And when we did it from 2011 to 2016, we found those costs increase on average almost 30%. So this is a big part of our argument to policymakers to say, if you want us to help improve housing affordability and improve housing inventory, you got to keep those regulatory costs down. So we'll have an update of that, and it'll be a big push, media push, when it comes out later this year. All right, so let's put all that together. We did demographics, macro, some policy issues, supply side issues. What do we think is going to happen? This is the NHB Wells Fargo HMI. It's our monthly builder confidence measure. It reached an all-time high of 90 in November. It dipped down to 86 in December, and the next edition comes out next week. What it's pointing to right now is two things. One, the red line is single family starts. We think that's going to continue to grow, but the recent weakness and probably the uncertainty with the election and regulatory issues and higher interest rates and higher prices is likely to cause a little bit of some leveling off in single family construction. So when we plug that into our forecast model, we get this. And this is the national numbers. I'll show you the local historical data here in a second. But on net, what we're expecting for the single family market, and I will admit, I'm among the more conservative forecasters for our own industry. There's some analysts out there talking about the new golden age of housing. I think some of that is a little overstated, but what we're expecting, you can see that dip down after the red vertical line. We're going to have some choppy conditions at the start of the year and then get back to the trend line that we've been on since roughly 2011. So on net, despite the fact there's going to be some ups and downs this year, we're looking at about a 5% growth rate nationwide. That'll be about half of the 11% growth that we had in 2020. And to give you a sense of how good last year was, at the start of 2020, I was predicting a 3% growth rate. So we ended up with 11. 5 is going to be about half the growth rate, but it will continue to grow. A little bit slower growth still in 2022. And the reason for that is, one, we finally get above 1 million single family starts. And we think the end point, in other words, where we kind of reach a new equilibrium, is about 1.1 to 1.2 million single family starts. So we're still below that demographic potential. And once we get up to there, we'll level off. That's going to occur over the next 5 years. If you look at the local data, and this is for the entire metropolitan statistical area, state level permits, according to the census survey, suggest about a 5% growth rate in Illinois in 2020. A little bit higher, 6 to 7% growth rate locally. But the big challenge, particularly for Illinois, remains what it has been, which is just the lack of a significant rebound after the Great Recession itself. And you do see this in a number of markets in the Midwest. And as I mentioned at the beginning, there is an opportunity here for some of these Midwest markets to grow. And I'll give you, just as a contrast, I don't mean it as like an attainable goal, but a city like Kansas City posted a 20% growth rate in 2020. 20% growth rate. They have no national builders, just an enormous growth rate. And the reason for that was housing affordability. They took advantage of that, and they were able to attract businesses and households due to the changing geography of housing demand. Some trends that are worth noting. Single family home size has actually been going down for the last 4 or 5 years in new homes. That's now leveling off, and we think it's going to increase in 2021. Home size is getting larger because in our surveys, home buyers want more space because they're doing more things in their homes that they used to do in commercial real estate. Work at home, study at home, exercise at home. 1 or 2 home offices, for example. I'm talking to you from my basement in a townhouse in Arlington, Virginia. I would love to be in a single family detached house with an office. So we think home size is going to go higher. And I've mentioned this repeatedly, but the geography of housing demand really did pivot in 2020. We've been calling it the Suburban Shift. The counties marked here in blue are sort of high density areas of the United States. They represent about 17% of single family construction. It was an up year for much of the country. You can see these areas grew on average a little under 6% growth rates. But as you shift out in terms of the lower density markets, you see the growth rate go up. So it's 5.7% on this map. If we shift out to the suburbs outside those areas, the growth rate over the last 4 quarters jumps up to almost 11%, with about a quarter of home building occurring in these counties. And if we shift out kind of the medium-sized cities, the places like Dayton, Ohio, for example, about 30% of home building takes place in these counties in red, a 12% growth rate. And in fact, if we go to the outer suburbs of those small metros, only about 9% of home building occurs in these areas, a 15% growth rate. Lower cost, lower density, much better. And this, some people said, oh, it's always like that. No. This was a pivot that occurred in 2020. And it was a pivot that was denied by the media for about 3 or 4 months. I was actively engaging with journalists who said this was a marketing myth. And I kept saying, no, we've got the data to prove it. Telecommuting, which affects 27% of workers, really did allow people to drive further to qualify. And if the workday is going to change to a 3-2-2 model, that is 3 days in the office, 2 days at home, and then 2 days off, like weekends, it means people can drive further to qualify. So that some of this is going to roll back. This goes back to my restaurant grocery store analogy. There's a bit of a rollback, but it leaves a persistent partial effect. And I think we see it in the geography, man. And just to give you an extreme case of this, these counties in green, these are the vacation home counties of the United States. They're counties with at least 15% of their housing stock or more that are vacation homes. 10% of home building occurs in these areas. They grew year over year in the third quarter at a 23% growth rate. So the second home market really boomed in 2020, and it can reflect maybe baby boomers accelerating vacation plans, for example. And oh, by the way, not just a single family story, all multifamily. Apartment construction was spreading out into the outlying areas. Only a third of multifamily construction occurs in these areas outside the counties in white, but these areas were growing a lot faster for apartment construction. And so if we look at the local data on multifamily building, it was a down year, both statewide and Chicago. Obviously, most of multifamily construction in the state is in Chicago. And you see this throughout the large metro areas of the United States. Declines in multifamily permits down nationally about 11%. And so when we plug all that into our national multifamily model, we think for 2021, we're looking at about a 10% decline this year before stabilizing in 2022 as the labor markets heal and the unemployment rate comes down, helping rental demand stabilize as we move into 2022. And that does mean, by the way, that the geography story that I told you, we're going to see a shift in production, less units built in 50 plus unit properties and more in that missing middle, which I think is a positive sign for townhouse construction. Because I think, that medium density may be the sweet spot between the super high end density, the steel and concrete type buildings, and living out in the country. That the walkable communities that still offer people a front door and no elevators. So missing townhouse construction is likely to experience some gains here over the next couple of years. Remodeling, strong year in 2020. Remodeling growth will continue in 2021 and 2022. The only reason that we have the growth rate slowing over the next couple of years is we think existing home sales will slow after some of the uptick that we saw this year. Generally speaking, in all our consumer preference surveys, people want to improve their homes, use it more efficiently, and have more space. And that's good for the remodeling market. So just wrapping up before taking some questions. This is a real contrast. We've flipped the script, so to speak, from the 2008 experience where housing was ground zero and took the longest to recover. Now it's unfortunately the other side of our construction industry. Residential fixed investment, which is home building added together, single family, multifamily, and remodeling. You can see the dip down that it took 2020, and now it's larger than it was before. So just like grocery store sales, just like the goods economy. In contrast, the red is non-residential construction. It's dipped down, and in our forecast model, it's going to take 4, 5, or even 6 years for non-residential construction to get back to where it was at the start of 2020 because of declines in demand for new office space, retail space, and those factors. So that's a challenge for our cousins, I guess, so to speak, in other parts of the construction industry. It's also an opportunity for home builders and remodelers to recruit workers from that sector into residential construction as that sector lags. The one wild card to this forecast would be a big infrastructure bill that would help non-residential construction heal. And with that, I want to thank everyone very much for attending. I will say we'll have a lot of different forecast session on multifamily and remodeling and geography at IBSX, which is going to be our virtual trade show. You can go to buildershow.com to register for it. I would highly recommend you do so. It's a shame we're not meeting in person in Orlando, but certainly it would help the industry. I hope help yourselves to register for this event and participate because this has been an extraordinary year. There's a lot of different changes in technology and preferences. And then my Twitter account at DeetsEcon is on here if you're into social media. And almost all the data that we talked about today is either available on our economics blog, ionhousing.org, or our subscription data service, housingeconomics.com. And with that, I'm happy to take any questions.
So the first question is from Rick Whitney, and he said, would you argue that the countries with greater GDP declines also had more vigorous responses to COVID?
Yeah, everywhere but the United Kingdom. And one thing to keep in mind, so I don't want to sound like I'm ranting about this, but this idea about comparing country to country on whether we're talking about confirmed cases or deaths from COVID, the United States is measuring almost all the COVID impact. There are plenty of countries, even industrialized countries, that are not. Anyone measuring Vietnam's experience with the United States' experience is just in a fool's errand when it comes to data issues. But yes, when we're talking apples to apples, what you'll find is that the countries that locked down more intensely had a much bigger impact on their economy. They didn't have as big an impact on the unemployment rates, by the way, because of government response. But somebody has to pay for it. So GDP, if you're going to lock your economy down for a long period of time, the size of the national economy has gone down. This is a big problem for Europe because Europe already had too much debt. It doesn't have the advantage of the US dollar and the Federal Reserve, which is, along with our Constitution, are our great assets. And so I am concerned about some of these older economies like Europe having basically shot all the arrows in their quiver, raised their debt levels, and had taken a really big impact in 2020. Their rebound is not going to be as strong as what we see here in the United States.
Right. All right. Thank you for that. And thank you, Rick, for that question. Our next question comes from Paul Kogan. He asks, how can you use comments or how can we use comments about how housing demand can have the greatest impact on economic recovery to benefit our advocacy in Illinois and Chicago? We need to convince policymakers that enabling housing growth is critical to economic growth.
Yeah, so I mean, my team produces a lot of things for this. I think, obviously the answer is engagement. But, in addition to our regulatory study, which I kind of was foreshadowing, we'll have an update on that. When that comes out, get that into the hands of policymakers and talk about the death by 1,000 cuts. That's the challenge, right? Because when we work in an individual issue in home building or remodeling, they'll say, okay, well, this impact is fairly small. The challenge is the fact that you've got to layer that on top of the other 100 other regulatory burdens or taxes. And it's the event in aggregate. That increases the cost of building housing and then prices out individuals from being able to buy housing. So we do the regulatory studies, and then we have a series of priced out estimates at the state and metro levels. Those are all available nationally. Every $1,000 price increase in new home construction costs prices out about 160,000 households. So I think the idea is, if you want to help us on the inventory shortage, and tell your friends in the realtor industry, if they care about inventory issues, they need to care about regulatory issues when it comes to home building. We need to get them engaged in labor issues and environmental issues that they don't think of as realtor issues, but they care about inventory. And so priced out analysis, housing affordability analysis, and those regulatory burdens, those are going to be the key tools to use here in 2021.
Great. And we have quite a few professionals in the real estate industry on our call today. So I hope they will take that to heart.
Please.
I do want to say that Paul Kogan, who asked the question, lost his internet connection. So I want to share that this is being recorded. So we will send out a recording of this session afterwards for anyone that would like it. Our next question comes from Frank Benetti at Inland Bank. What real impact does the stimulus have on the economy? It seems that giving everyone a relatively small amount doesn't really help. Why wouldn't they give more money to people and businesses who actually need it for a longer period of time versus just sending money out arbitrarily?
Yeah, so policy design matters a lot, particularly in terms of getting long run rebound impacts. So let's divide monetary stimulus, which is the Federal Reserve, and fiscal stimulus, which is the president and the Congress. On the monetary side, by definition, the stimulus is broad. Low interest rates, purchases of treasuries and mortgage-backed securities that keep long-term interest rates down, allowing businesses to borrow. That's going to be critical in 2021 as parts of the economy restart, and allowing people to go get mortgages and buy homes. Broad works on the monetary side. On the fiscal policy side, it needs to be more carefully targeted. So I think most economists, conservative economists, liberal economists would have said in 2020, given the big drop off in GDP, any kind of fiscal stimulus was needed. And so we were doing 1 trillion at a pop. Now the Biden team is talking about 2 trillion. That may be too large for the next stage, because you then start to risk some inflation. But I would say, again, policy design matters. So the question is, does mailing out small checks have a big impact? No. It does help some people pay the rent and pay the mortgage, and that's certainly a good thing. But I think at this point, they need to be more narrowly targeting. And so one thing that I'm in favor of is reducing the payroll tax, the FICA tax, because that will have 2 impacts. One, it's progressive. It tends to benefit lower income people more, but it encourages you to go out and get a job. Because the problem with checks is it doesn't incent different kinds of economic behavior. That's going to be a difficult argument to make going forward, but I think that's going to be key. And then the other factor is making sure that those sectors of the economy that have been particularly hard hit have access to capital to restart. And so again, that'll be the hospitality industry. So there's a lot of work to be done. I hope that policymakers will move carefully. And of course, we also have to keep in mind inflation risks 5 to 10 years down the road.
Great, thank you for that. The next question is, have you quantified how rental assistance will impact the economy? Preventing foreclosures among landlords limits evictions.
So the $25 billion rental assistance package that was in the most recent stimulus bill, I think was just about the right size, maybe a little bit smaller than the need. I am not expecting, in terms of our forecast, a big wave of foreclosures. I think we will see some. There were some terrible estimates out in 2020 that we were going to see 30 or 40 million foreclosures for the US economy. They came from academics at NYU, the eviction lab. Those numbers were garbage. They were fear-mongering at its worst. They were based on a survey that was poorly done and not well understood. We think in the coming year, we could see 3 to 4 million foreclosures. Now, that's not a good outcome. It's a factor of 10 smaller than what was forecasted. So I think it's going to be a key issue. It's going to be a key issue in high density areas. I'd like to see a little more rental assistance to try to help landlords who have essentially been carrying the bill during the eviction moratorium. But generally speaking, I think the policies in that area have been just about the right size. We need a little bit more help going into 2021. And I'll just say as a footnote, I'm just talking about residential. Commercial rents are a different story. Clearly, there's still a lot of stress in that system. And since they asked about it on foreclosures, we are going to see an uptick in foreclosures this year, but we're not going to see anything like what we saw in 2008 and 2009. The foreclosure forbearance program was well crafted for a lot of homeowners that weren't able to pay. And that rate has gone down to, I think it's like 3% of mortgages now. It peaked at 8%. So about half of people took that out as insurance rather than an indication that they actually couldn't pay. So we're going to see some uptick in foreclosures, but it's not going to be like the waves that we saw during the actual Great Recession.
Do you think we're going to see, as we saw that migration out to the suburbs and the exurbs this year, will we see a contraction in that and having houses that will be empty in those areas?
Maybe not empty, but if you're sitting in a exurb in a 20-year-old house that needs, repairs, your competition is going to go up this year. Because again, I think we're going to see some rolling back of that demand that kind of went outward is going to come inward as the cities reopen. But again, keep in mind that 3-2-2 work model that could be 30% of the US workforce. If that's the case, like in my area where I live now in Washington, D.C., I'm in Arlington, well inside the Beltway, but many of my neighbors are saying, I only go into the city now 2 days a week. I can live out as far as Fredericksburg or Frederick, Maryland, and live in a new, much larger house. That calculation is going to be made, and there are going to be a group of people for whom that opportunity is going to persist. And I do think that is a growth opportunity for home builders, for remodelers. It's about tear downs. It's about expanding the existing housing stock in close-in locations.
Great, thank you. Jim, do you have some other questions?
I think Robert did a good job. He covered most of the stuff that I had on my list here. So we can open it up once more to anybody on the call here to see if there's any further questions. If not, it doesn't look like there is. So Robert, thank you.
I have a question.
Go ahead.
Question.
We got one last one.
Okay. Yep. Okay.
We have a couple.
There's Bill Ward with the Home Builders Association of Illinois. There's going to be a big push for diversity in housing in the next Illinois General Assembly. And we're not talking about housing support for rental multifamily. They're more interested in diversity in single family ownership. And one of the questions I'm getting asked is, what is the current rate of affordable housing in the state of Illinois, and where should it be? And I don't have an answer for that. Do you?
I do have the answer. I don't have it in front of me. So we do an HOI. It's called the Housing Opportunity Index. It's our affordability index. Now, we don't do it at the state level, but we do it for every metro area in the country. Right now, about 60% of newly built homes are affordable for a typical family. We'd like to see that get up to about 75. I don't have the local measures in front of me, but for most major metropolitan areas, it tends to be right around 50 or 40. So in terms of improving the attainability of housing, it typically means building more entry-level housing and getting some of that lower cost housing. But as you heard through my presentation, that's going to be incredibly difficult to do in 2021 because we've got building material costs going up. We have an ongoing skilled labor crisis. So we know new home prices are going to increase this year, which is moving in the opposite direction. And we're not going to see a lot of income growth. I mean, that's the other challenge. We're in a recovery. So I think you're exactly right. And we're starting to hear this, by the way, from congressional policymakers, the incoming team at HUD, in terms of diversity in housing. And we can talk about that in terms of age. We can talk about in terms of race and ethnicity, in terms of looking at the homeownership gaps that exist among ethnic groups, and then within the structural variety of housing that's going to be available. That's something as an industry we're going to have to come together on. And the role that we can play is to say, we can supply housing, but you got to help us provide particularly the attainable housing at the lower end. And that's one reason why I think the missing middle townhouse construction in large metro areas can be an important part of that story. If we don't offer solutions or plans, we know what's going to happen. They're going to force affirmatively furthering fair housing type policies, inclusionary zoning policies on us, and basically say, we're going to make you do it in order to get permit approval.
Yeah, I think we have an opportunity here to hitch our wagon to this. They've already asked for our ideas on how to lower housing costs, which I was very surprised to see and happy to see. And so we're going to attempt to do that. So any statistics you can provide us along those ways. And then I know, like the Canadian lumber tariff and things of that nature. I was talking to Senator Durbin about that in October, and he says that's one of the first things they want to accomplish under the new administration. And so things like that are going to be helpful.
Yeah, and I'm glad you mentioned the Canadian tariff. We had that 21% effective tariff rate. It drove down imports of Canadian lumber in 2020 down by about 5%. The rate got cut from 21 to 9. It was one of the last acts of the Trump administration, so they cut it in half. My hope would be that we get a new softwood lumber agreement. I was just talking to our friends at the Canadian Embassy a few days ago. They're focused on rebuilding the relationship with Canada. We know President Trump and Prime Minister Trudeau did not get along very well. There are some reasons behind that, but hopefully we can get the lumber trade back up to where it needs to be and get some stability in the pricing. And as you said, the other issues as well, where we can be the good guys. I think that's really the opportunity here for the industry, is to say, let's offer them solutions. We know what they are. Let's offer them and keep our mind on what the targets they want to achieve. Otherwise, they will become our opponents and they're going to force regulations on us. And that's a PR challenge.
Yeah. Well put. Thank you.
All right, Rob, we have another question from Jim Koala at Guaranteed Rate. Have heard from several home builders in Chicagoland that they are seeing families buy multiple homes in the same neighborhood during the pandemic to be closer together. Is this a trend that you're seeing nationally as well?
As an economist doing a presentation, you hate to give this answer, but the answer is I don't know. You'll always hope that you've done your homework and asked all the questions. That's a great question. I have not asked that in any of our surveys, and it's probably a blind spot for me because I don't live where I grew up, nor do all my neighbors live near family, so it's sort of impossible. I'm going to add that to our preference surveys that go out once a quarter and see if maybe that's causing some shifting the kinds of demands. My expectation would be, I'm just guessing here, it would be small, but it would be a positive for builders. But that kind of effect in terms of thinking beyond the vaccine would probably dissipate a little bit. But that's a great question. I honestly don't know. We know that over the last 10 years, we saw an increase in multi-generational homes. They represented about 3% of the housing stock. And as the US demographic base becomes more diverse, you do have communities where multi-generational living is more the norm. And that means larger homes that have multiple kitchens. You see a lot of this kind of design type issues in areas like Dallas and Houston, where large numbers of South Asian communities, for example, are coming into Texas. So that's an interesting one. Maybe it suggests communal lots with different structure types. We'll have to ask that.
Great. Okay. Well, thanks for your honesty, and Jim, thanks for that question. Jim, do you want to wrap it up?
Yeah, no, that was great. I would like to say thank you to Robert. Very, very great presentation, very useful stuff. Thank you to our sponsor, Inland Bank. And thank you to all who attended. So stay tuned. We'll have great events coming up here in the future. So stay tuned and come back for more.